Well, hello guys, it's Clark, and we are back for another edition of our weekly Wednesday. This week's topic across the board has been assets. And so we want to kind of continue our topic and discussion about that and what all that involves and how it impacts you as an agent and your buyers. And so just wanted to kind of give you, a rundown of what it is that we have available for you. So before we get into the type of asset documents that we're going to be using and the possibility for your buyers, I want to make sure that we cover the most important thing as it relates to assets, especially if you don't have time to stay to the end or you choose not to watch it till the end. I wanted to basically start with the end in mind, and that is the cash that we need at closing. Okay, so we're going to go over the type of assets that we can use, but the number one thing that's overlooked in this space is the amount of money you need at closing. For example, if somebody is buying a $200,000 house and they're putting 5% down and they say they have $10,000. So let's look at that. So $200,000 house, okay, putting 5% down. They're looking at saying, oh, I need $10,000 down payment, right? Well, that is true. But the problem with that is what they're not accounting for are all the other things. So as the expert, you need to be able to, you don't have to give them down to the penny, but at least you need to know what it is they need. And we have a video that's dedicated solely to this, goes in a little more detail. I would encourage you to actually take a look at that. But what I'm referring to here is, here's how it would come up, and here's how you would even discover this, right? If you're talking to them about, when you're basically having a conversation with a buyer, in your buyer consultation, are you having preliminary conversations about, are you employed, and how much money do you have set aside for down payment, closing costs, and prepaids? If you know the price range they're looking in, and their goals in terms of how much they want to put down, you can kind of fairly quickly come to a determination of where they're going to be. So using this example here. So if we have a $200,000 buyer, they're putting 5% down. Okay, that's not an interest rate, that's 5% down. That's $10,000, right? So if that's the case, not only are they going to need that, they're also going to need a year's worth of insurance, which could be $1,000 for insurance. They're going to need basically a year's worth of property taxes, because whatever we don't need to set up their escrow account moving forward, they're going to have to, in prorations, pay back to the seller on the other side of it. So it typically is about 12 to 14 months worth of taxes are needed at closing as well, which most people do not know, nor do they account for. So depending on where we're looking, okay, for our conversation, we're going to assume that the property taxes are going to be $4,000, just as a launching point, right? So they're going to need anywhere between $4,000 and let's just say $4,400 for property taxes. Then you have closing costs, which are going to include title work, which is the most expensive in this particular space. You have what the lender charges, okay? We charge $825. You have compliance fees that many of you charge. You have appraisal and all the settlement charges, all the different things that are involved. And those are going to be, let's just say, roughly about $3,000. So we have a down payment, we have insurance and taxes. There are about $3,000 in closing costs. So just roughly, just using this very quick overview, what you can see here, this $10,000 went to, in this situation, $18,000 needed at closing. So in your preliminary conversations you're having with buyers, and you say, hey, you know what? We're looking at the $200,000 price range. Okay, how much money do you have set aside? This is a very easy conversation for you to have. If they say, well, I got about $2,000 saved up. And you know in your head that they're going to need roughly, because you know the properties that they're looking at, you know they're looking in Livonia, or they're looking in Westland or whatever. So you know the annual taxes, okay? Roughly, you can assume at that price point about $1,000 in insurance. You know, and insurance is easy because even if you're off by, you know, a full $100 is not much. So if you just assume right around $1,000, that's pretty safe. Closing costs, oh, I'll put that label down here. The higher price point you get into, the more this will go up, because title work is a direct reflection of the actual loan amount that they're borrowing. So, but roughly looking at here, if somebody says, oh yeah, looking at $200,000 house, even if they say, yeah, we got our 5% down, we got our 10,000, you know that they're going to need roughly 18. Then what does that mean you're going to have to ask for? Concessions. Well, if we're in the space of a conventional loan, primary residence, they can ask for 3% in concessions. That's $6,000. If you even want to go there, right? In the competitive market, that's tough to get, but I do see it happen. They're still going to be $2,000 short with that math. So my point is, what this does is it allows you to be able to, now we're going to reaffirm this. We're going to tell them the why behind it. But what it allows you to do, as I mention all the time, is you buy things with your time, not with your money. And so if you're showing a buyer around at Homes who hasn't been pre-approved by us and aren't having these types of conversations, you're going to be showing a buyer around that doesn't have enough money at closing. Now, can they get some other, is there a way to tap into some other monies? Well, that's what we're going to talk about now. So these are the areas at which they can actually tap into. So the spaces are where we can use, okay? This is just a general overview. This isn't meant to cover every single topic that there ever was about assets. Just as a general overview. Typically, large majority of the time, what we use are checking and savings. All right, that's your normal everyday checking and savings account. Many buyers have separate accounts that they set up just for the purpose of this. Maybe it be a savings account, money market, whatever it is. They've been saving up for this. So that is what we're using typically, okay? And that's totally fine. We'll need to see, just as a informational sake, we need to see actual statements. A lot of times people provide transactional histories, which we can't use. The reason why is because most of the time it doesn't have at least a portion of the account number, and it rarely, if ever, has their name on it. So we have no way to attach it to that particular client. So just kind of heads up on that. Something that we deal with, but just want you guys to know. Retirement accounts. So sometimes people have monies in their retirement accounts, vested accounts. They have to check with their provider and how it's set up. In many cases, they can actually borrow against their vested retirement, which is awesome. Because the great thing about that is, one, it's allowed. We're allowed to do that. And two, they're actually paying themselves back and getting a rate of return on their retirement. So that is a strategy a lot of people will employ if they have vested retirement accounts. So that's a good thing. Gifts. So gifts is something that certainly they can use. It can be used on FHA, conventional, anything. It's totally fine. The documentation required and who the giver is depends on the particular program that they're involved with. So make sure if you have questions about that, make sure you talk to us about it. I don't want to get in the weeds with that, but there are some stipulations not only in the paperwork that's required, but also with with whom it can be coming from. So make sure you were clear on that as well. Now, one thing that we run into that are issues with assets, that are large deposits. So large deposits would be a deposit that goes into the account. Doesn't mean that it's a lot of money. Don't confuse the word large with, if they have a lot of money coming in, then it's a problem. Because if they make 10, 15 grand a month and it says, ABC company payroll, doesn't matter. I could say $100,000 on there. There's no issues. The problem is if it just says cash deposit or counter credit or check. $9,000 goes into there. It's not a problem as long as we have a paper trail for it. If they do not have a paper trail, that will cause issues. Okay. Same thing with, and we'll kind of lump this in here, cash deposits, random just deposits of cash. Some people don't trust banks and they, what it used to be called mattress money, they'll have it in the safe at home or they'll have it in their freezer, wherever it is that they're storing up their money. And then all of a sudden they one small account that they have, they'll drop in a bunch of literal cash deposit. And that has to, if they don't have a paper trail for it, which is typically the case because they've been saving it over time or whatever happened as to why they get cash, we're not going to be able to use that. So what happens is this. So even if you ask the question, and we always do, once again, this is why it's important to have them have a discussion with us, the buyers, right away, early in the process, because we may say, oh yeah, you may even ask the question. Some of you may not feel comfortable with it. It's up to you. They may say, yeah, I got 20 grand in the bank. And in your head, you kind of already gone through this discussion. You're like, okay, they're going to need around 18,000. They have 20, we're good to go. But then you show them homes and they come to find out they had an $18,000 cash deposit last week and they have no paper trail for that money. We can't use it. That client has $2,000 in the bank as far as we're concerned. So here's what has to happen in order for that to work. Say the deposit went in yesterday, or I said last week, okay? So February, shows on February's statement. We're gonna need to see March's statement without that large deposit and April's statement without that large deposit in order for us to be able to use that money. It's called seasoning. What it is, the reason for that is because they didn't get a large deposit put in there in February and then 3 weeks later pull it back out for somebody else. Or they didn't borrow money. Here's why large deposits is a big thing. They didn't borrow money from over here and put it into their account to buy a house. You can't borrow money from somewhere else to buy a house. The exceptions to that are with your retirement, as I mentioned, and if you have an asset that you're borrowing against, a home, a vehicle, something like that, where we can show that it actually is what's called a secured asset, okay? Once again, not to get in the weeds, but just to kind of give you some ideas and strategies that we, with our experience, have been able to leverage for clients if they fall short of this number over here. So once again, getting back to this cash deposit, this buyer who we work so hard, we've mentioned in many cases, this is why we're trying to always prevent these pitfalls for you. We work so hard to actually find a buyer that's willing to talk to us and willing to work with us. They tell us they have enough money, you've done your due diligence in that area, and then they come and talk to us and all of a sudden we discover that they have this deposit and that client's not eligible to buy a home until May. I doubt that seller is going to be willing to sit around and have a 90-day contingency for closing. Probably not the case. So it's very important that's why I said cannot impress upon you enough how important it is for you to make sure that they speak to us early in the process so we can avoid these things. And trust me, I know I've had people get frustrated by it, and I understand the frustration, but sometimes the frustration is misdirected because they get frustrated with us because we can't use that money, but we weren't the one that actually had this undocumented deposit, right? So large deposits are some things. There's some different stipulations of how much is actually considered large. For a conventional loan, just to kind of give you an overview, it's 50% of their gross monthly income. So if they make $8 grand a month, they can have large deposits up to $4,000 in most cases, okay? If there's consistently going on, then that may raise a red flag and underwriting is going to ask for some type of documentation for that, right? You can't have 7 different deposits of $3,500 go in there and then say, oh, don't worry about that, right? Likewise, with an FHA, it's certainly a lot more strict. That rule is 1% of the purchase price. So if they're buying a $200,000 house, using our example, $2,000 is the max in terms of a large deposit that we have to make sure if anything above that, we're going to have to document. Once again, their payroll is easily documented. They have a pay stub, simple. And it actually says a lot of times, many times, payroll or, their company. This time of year, what happens? People are filing with taxes, right? And so they're going to have large deposits coming in. Is that a problem? The question is, that's the question. The answer is no. Because of the fact that it says right on there, U.S. Department of Treasury, if they get a direct deposit. Okay. I would encourage, if you know that a client, for whatever reason, if they've chosen to get a physical check from their tax return, make sure, and this for whatever reason, say it come up or whatever, and you know that they're getting back $5,000. Have them deposit the entire amount into the account because it'll show the paper trail. And if they want $100 out to go to Target or whatever from that, deposit it and then take it out in a separate transaction. Don't deposit $4,900 because that makes it, you would think sometimes logically, but In terms of documentation, we have to make sure we show the $5,000 check, the $5,000 deposit. Transactions that happen after the fact, we're not super concerned about it. Or that paper trail has to equal each other in order for us to be able to substantiate that. So assets, once again, as a general overview, are the monies that we're going to be using to purchase a home. That's what you care most about, right? These are the major categories of assets that we are typically looking at. Of course, there are others that aren't necessarily covered on here, but they're kind of like fringe things that we don't see very often. These are the major things you're going to see. If there falls into a situation where our client is short funds to close, maybe because of a large deposit, maybe because they just don't have enough money because they haven't saved long enough or whatever it is, or they have, cash deposits that we can't use. If they can't get a gift, if they can't borrow against their retirement, then really the only thing we're going to have left to do is concessions. Okay? So make sure, and I know they can work, but I know a lot of times as an agent, whenever you see me say, yeah, they can purchase a $200,000 house, but they're going to need 5,000 concessions. Your first thought is, great, right? Let's be honest. But in order to get that client into that house, we might have to build that into what it is we're doing. All right, guys, hopefully this was helpful for you. If you have any questions about assets or anything else that is mortgage related in terms of helping buyers, feel free to reach out. And as always, guys, choose a great day. We'll see you next time.